Yeah, Mike Swanson. I want to do a really quick video showing you the ratio of down to up volume, what that means, how you can track it, and because I'm getting a lot of questions about it, and something really dramatic happened with it yesterday. Anyway, if you go to Yahoo Finance, click Read More Market Summary. Uh, Actually, click the Read More, and it'll take you right to it. Right here it says advances and declines. You can see the advanced declines, number of stocks rising and falling. And this is down volume and up volume. It's not accurate before the open. You have to look at it during the trading day or after the close. But yesterday, that ratio hit past 9 to 1 on the New York Stock Exchange and the NASDAQ. That meant for every buy order, there were at least 9 sell orders, and that's a sign of extreme selling. And what is a buy order and sell order is something people are asking me. Well, a sell order is when someone simply hits the bid, and a buy order is when they hit the ask. Now, what's important about this is that during downtrends, usually they'll continue until you get a day in which you see an extreme reading on this of 9 to 1. That only happens normally just a few times a year. And when it does, it typically marks the end of a correction. And yesterday we saw a day exactly like that, which makes me think that for the short term, the market's going to bounce back higher and recover and shake off the big down day yesterday. It would be unusual for that not to happen in the short term. Anyway, this is a chart on stockcharts.com, symbol SPX, SP500. And what I've done is plotted the up volume here and the down volume down here. And this is how I've done it. I created 2 indicators, parameters, $sign, NY, UPV divided by, or that's a colon there to create the ratio, money sign NYDPV, creating 2 ratios. The green is the ratio for the buys, red's the ratio for the sells, and you can see there have been a few times in the past year since the March low where this has actually happened, that we've had 90% of the volume on the downside. Yesterday being the last time. Before that, the day the market bottomed in February, it happened. There's a day, I think it was right after Thanksgiving it happened, a time in October, a time in September, a time in July. And I know you see some spikes that were very high, but they're not necessarily counting because the up volume wasn't extremely low to match the high down volume. Again, I'm pointing out yesterday, Tuesday, it happened. February on the day the market bottomed. November on the day the market bottomed. October on the day the market bottomed. September on the day the market volume. July on the day the market volume. Of course, there were multiple times that this happened in the last bear market. Until the market collapsed, every time it would happen, it would actually mark the end of a correction. There was a day like that in March, for example, in July, for example, of 2008, and of course in January. The market crash was a little bit different because that was a complete wipeout. And actually in March we saw it happen on the day the market bottomed too. Point being, what I want you to take from this is that when you have extreme selling days like this, it's very unusual for the market not to immediately turn around the next day and at least trade higher for a little while. And in February, in October, July, September, those days might mark great buy points in the stock market. I'm a little worried though that right now this is going to be more like what we saw happen in November, meaning that instead of the market, having such a great buy point as we saw February or July, that we're going to recover, go back up to the highs, and probably go sideways for a little bit for the next several weeks, and maybe we'll break out again to a newer high then. But I really don't feel comfortable buying until for the long term, until we see the market dip back down to at least the 50-day moving average, and more likely, and what would make a better buy point is dip down to longer term 150-day or 200-day moving averages. A buy point, a dip down to one of these levels coinciding with a panic day like we saw in February or July, I would think would make a great long-term entry point where you could buy with expectations of holding for 6 months or quite likely into the rest of this year and into next year. But instead, we've got a buy point above the 50-day moving average, and the way I would treat that is not look to necessarily buy and hold. If you're going to buy, an ETF or a mutual fund in the market averages, but instead look for select individual stocks that are in good positions of their own. And if you can't find ones that are starting new bull markets, then you're basically going to have to, I think, trade with a shorter time frame than you would otherwise. But anyway, I think this gives you a good idea of what happened yesterday, why yesterday was a very eventful day when it comes to the internal action of the market. I know the news is negative right now. I know there's lots of fears and lots of talk about the Greek debt problems, but that's again why I think this situation is very similar to what happened in November. If you recall, in November, we had this panic day right after Thanksgiving, coincided with worries about the Dubai debt crisis. The February low coincided with talk and worries about the Greece debt situation. And once again, those worries broke out yesterday, with the addition of Portugal being added to the things to worry about. So anyway, be talking to you later.